Tesla probably does that better than any other car maker that's out there today. Phase one of the DCF, just at a high level, was saying if Tesla's just a car company and it's just selling, all these vehicles that it's introducing, it's probably only worth, by my assumptions, about $104 a share. By the way, that's a lot less than the $180 a share that Tesla's trading hands for today.
Could Tesla stock, which is currently just shy of $180 per share, really be worth something closer to $645 per share? That sounds like a big number, but looking back years ago, if you had predicted a similar rise for Tesla, people would have thought you're crazy, but you would have been right. My guest today is my friend Simon Erickson. He's the founder of 7investing.com. This is a stock research service, and he has done a ton of research into Tesla, which I'm not a millennial, but I believe if you are a millennial in the US, you're almost legally required to own Tesla. Simon says under certain conditions, Tesla stock could be worth $645 per share or a lot less, depending on how you frame it. So first of all, Simon, welcome.
James, it is a real pleasure to be here. You and I have chatted about quite a few valuation models over the last decade or so. Really glad to be on the show here with you.
We have. And, I love valuation models. I used to teach valuation modeling at the Motley Fool, where we both used to work. I think there are too few people out there bringing real substance of conversation to the investment space. Is so easy to latch onto a data point here, a soundbite there, something that reads well in the news, but like isn't connected to that framework, that sort of mental Christmas tree that you hang your ornaments on. And a valuation model, a discounted cash flow model in the case of what you made, is really that framework. And if someone's new to this conversation, it may seem imposing, it may seem scary, right? But it's basically just saying, look, a stock, a company is worth the sum totals of what its future earnings in a cash sense are, minus whatever debt you got. Okay. And then also adjusted to a present value sense. A present value meaning like a promise from me of $1 in the future is not worth as much as $1 right now, right? There's a time difference based on A, sort of a bare minimum opportunity cost, and B, how sketchy James Early is. The same logic applies to the company. So DCF sounds complicated, but you're really just projecting those future cash flows of the company. It's kind of a guess. You're projecting the probability or the riskiness of those cash flows appearing or not appearing. A riskier company, you'd have a higher discount rate, it's called, right? And then you're bringing them back to a present value. So there's a lot of like accounting stuff, but the key parts, the key inputs are really growth and discount rate. So with that James Early, like mini kind of semi-boring lesson aside, Simon, why don't you introduce how you framed up this Tesla model?
Oh, that's great.
What made you prompt you to do this? Because this is a lot more work. I mean, I've been in the newsletter space for a long time. I'm not in that space now, but I spent a long time. This is a lot more work than people normally do.
Well, I have. I'm glad to be here. I have 52,313 line items, and I'm going to go through one at a time. I'm sure really excited about. No, I'm just kidding.
I need to upgrade my Zoom subscription. Yeah,
all in point one font for everyone to look at. Thank you for introducing, kind of why we did this. The whole reason in the first place is Tesla is one of those battleground stocks out in the market, right? Depending on who you talk to or what TV show you're watching at the time, or, what time of day it is or what week it is, people either love or they hate Tesla. Some people think that Elon Musk is brilliant and this visionary that's going to, solve a lot of the world's problems. And then other people think that he's an idiot and Tesla's going to go bankrupt in any given year. And probably the truth is somewhere between the two of those. But we said, okay, rather than just kind of having these statements that you always see on social media or in media, wherever it might be, let's put a stake in the ground and actually come up with a valuation for Tesla. Let's look at everything that's going on out there. Let's look at how they've scaled up their previous models in the past. Let's look at what they're working on right now and some of the challenges they're facing right now. And then also what Elon's bigger picture goal is, knowing that he executes very, very well too, James, and pull it all together exactly like he described and through a discounted cash flow model to say, hey, based on all of these inputs and all of these assumptions, let's make a forecast in the future, discount those back to the present, and figure out at the end of the day, what the heck is Tesla worth in terms of price per share today?
Excellent. You said it so well. And Elon is really a polarizing guy. I mean, he's really many different identities, and he's fully, truly each of those. He's weird. He's also brilliant. He's changed the world, for better or for worse. He can be petulant and bizarre. He's all those things. And so it's very easy for Tesla, which is his only publicly traded company. I believe the majority, or at least the biggest chunk of his net worth is tied up in Tesla versus some of his other projects. It makes sense for this to be such a battleground stock. And it's proven doubters wrong, I would say, generally speaking. I mean, there have been people saying there's no way Tesla can be worth this many years ago. I mean, it's just impossible. And and he's also had projections about when self-driving was going to be ready, and oh no, it's going to be later, it's going to be later, it's going to be later, and he's been sued about that, I think. So there are legitimate points of controversy on both sides. So I think what you're doing is saying, hey, let's distill this to some numbers here. Let's make an actual model. And by the way, some people might say a DCF model doesn't fit a growth stock well. I say no. I say you could have used a DCF model to value Microsoft in the late 1980s. It would have given you a number that looks so bonkers, you wouldn't have trusted it if you had actually put in the actual growth inputs. But the DCF sort of always works. It's just they tend to bias us towards mean reversion, and it's hard to assume this company is going to grow, at a high level forever, because most companies don't, right? But my point is the structure of the DCF always works. It's just our own cognitive biases sometimes make it challenging to put in the real honest inputs. So why don't we talk about some of your real honest inputs? You have here as and I'm just reading from your very popular Twitter or X post, and you've also got a piece up on 7investing.com as well. Tesla, the car company, is only worth $104 per share, yet Tesla as an AI company is worth $645 per share. That's a big discrepancy.
It really is. And, this is one of those high risk because there's high uncertainties in Tesla's future. I actually kind of broke it up into parts, James.
Mm-hmm.
This is a giant elephant that you go after one piece at a time, right? The old saying, well, how do you eat enough? You take one bite at a time. Tesla is a hugely complex beast that's got a lot of moving parts, literally and figuratively. And then, of course, you got the Elon factor in there as well. But if we were really distilling this down, the very first step I took said, let's take AI off the table. Let's not talk about AI. That's like the first time anyone said that in the last 10 years. But like if we remove all of the AI stuff that Elon wants to work on, and we just look at Tesla as a car company who's building gigafactories and improving manufacturing, introducing and then selling new models, what is that business worth? And I didn't really go super conservative in the assumptions. I assumed that the Cybertruck, which they're introducing right now out of Austin, eventually sells 250,000 units per year. I think that by 2026, 2 years in the future, Tesla is going to introduce its Model 2. A lot of people have been talking about this, but this is the mass market affordable. Yep, $25,000 or so that Elon wants to get into everybody's hands. Kind of competes with the Honda Accord or the Toyota Camry, James. This is something that's a very, very affordable price point and completely electric. And then I also think that something else that Tesla does very well is it learns. It innovates quickly. The gigafactories scale up incredibly quickly, and the learning curve translates into lower operational costs per unit of output. Tesla probably does that better than any other car maker that's out there today. So phase one of the DCF, just at a high level, was saying if Tesla is just a car company and it's just selling, all these vehicles that it's introducing, it's probably only worth, by my assumptions, about $104 a share. By the way, that's a lot less than the $180 a share that Tesla's trading hands for today.
Yep. And in terms of numbers, I just searched for just quickly. It says how many Camrys were sold. So 295,000 Toyota Camrys were sold in 2022. So that, just for scale, a Cybertruck might be modestly less than that in terms of ramp up. What are some other assumptions in this sort of baseline car company only model?
So globally, there were 90 million light vehicles sold last year in 2023, right? Total, and then electric vehicles was about 13.5 million, right? So call that about 15% market share of the global passenger cars sold.
But that's a lot, actually.
A lot higher than a lot of people would even think.
Yeah.
You don't realize that electric vehicles, it's a little bit lower than that in a lot of economies. But China shooting through the roof. This includes plug-in hybrids in China, which are very popular over there. And Europe is very, very big on electric too. But if you kind of look at if you kind of grow that top line number, that light vehicle sales kind of closer to GDP. But we have a much more aggressive growth for electric vehicles, and then Tesla's share of that too.
Mm-hmm.
One of the big assumptions that I said is that Tesla's market share of the global EVs sold today, about 13.5%. Really good, really impressive. I think they hold on to that market share, James. I had them getting up to 16% market share by the year 2030, especially as growth in the US and Europe really adopts a lot of their EVs.
Got it. Okay, so this is not a wild assumption, it sounds like. I mean, it's more of a status quo type. You wanted to get a baseline. and $104, I believe, per share was the baseline. If they're just plain old car company selling cars, which is, I mean, it's not something. I mean, it would be a stock price decline, but it's not like it's worth zero, like the Tesla haters used to say a long time ago. This company is going to blow up, is worth nothing. They were wrong. They were wrong. I mean, he surprised in the upside many times. So if it's just a car company, Simon says $104. Walk me through now to this $645 per share valuation when we start to bake in AI.
Yeah, and just to clarify one more thing too, is that when we say just a car company, it does also include the leasing business, the servicing business, and then also some modest conservative assumptions for the energy business. James, that's like, the solar panels on roofs, the battery packs that, are storing charge and things like that. Got it. But okay, so now let's get to the fun part, right? Why is Tesla selling for $180 if we say it's only worth $104 as a car company? And that's because you've got Elon Musk at the helm. In the driver's seat, you've got one of the greatest innovators of all time. This dude sleeps on the factory floor. He's got like a cot out there right by, the mechanical assembly lines. And Elon, I've never interviewed him, James, but I interviewed his cousin, Lyndon Rive at Solar City. He said if there's anything that he's learned in his whole life, it's do not bet against Elon Musk. And he's, like you said, he's proven the doubters wrong time and time again. But on the other hand, he's trying to solve some really, really tough things right now. Right? When you're talking about full autonomy, full self-driving, all the safety considerations, all the regulatory considerations, all the consumer backlash every time something in the media hits, this is probably one of the biggest challenges that Elon has faced out there right now. But it's also more than worth it in terms of the value that he can create by transforming Tesla into not just a car company, but a transportation company. And that's going to have two factors to this. I took it in two pieces. The first piece was full self-driving, which is kind of a software that is embedded into the car that Elon is now selling to you on a upfront or monthly recurring basis.
About $100 a month, right? Something like that, yeah.
$100 a month, exactly. $100 a month now. If you wanted to the hardware is already there. If you're buying a Model 3, if you're buying a Model Y, it's already there. It's just that you'd have to activate it and then update it. You pay $100 a month to basically have your car drive you around. All of a sudden, James, instead of just paying $35,000 up front for a car, Tesla's getting another $1,200 a year out of you for full self-driving if you activate things like this. And so he's kind of transforming a car company, which has traditionally sold vehicles up front, collected revenues up front, competed very heavily on price and rebates, into kind of these recurring software vehicles where he can embed the full self-driving that continues to iterate and improve.
Yeah, and if he's making $1,200 a year in profit off of you from that, I mean, compare that to, the profit margins. I understand it for cars are all over the map, anywhere from $1,000 to $14,000 for like a nice SUV. But if he's doing basically that every single year, it's actually a pretty amazing profit stream too.
It really is, And so the first step was I made some assumptions about out of all the vehicles that Tesla has on the roads right now, which bear with me, I'm going to pull up a number real quick just to put some clarity to this. But right now, first quarter 2024, there's about 5.7 million Teslas globally on the roads right now, right? And by the numbers that I had seen, about 10% of those, of the total 5.7 that are out there, have at least tried the free full self-driving trial. Mm-hmm. You get a month for free to test it out. Not everybody is actually paying for it right now, but about 10% of the people that have a Tesla have at least tried it. And an estimated 2% of those actually have it activated right now. They either paid up front or they're paying the recurring. And so let's scale that up, James. We know that it's still pretty early. A lot of people are kind of hesitant to get into a full self-driving Tesla. A lot of people just don't want anything to do with this at all. But if we know anything about innovation, adoption does over time kind of catch on. People become more comfortable with it. You see the safety records, word of mouth, things like this. And so I basically kind of scaled those up and the models up for everybody to see. But I think that if you discount all of the cash flows from the full self-driving opportunity, again, this is autonomous software that's in your car that you are buying for you to personally drive because you just want it to drive you around. I think that adds about $100 to the share price of Tesla. Suddenly it's worth $204 a share versus $104 a share, only off of the fact that Tesla's now incorporating full self-driving and getting a recurring revenue stream out of it.
Interesting. So the FSD about doubles the valuation. And by the way, we see these things like, a self-driven car kills pedestrian. It's horrible news. I think we need to remind ourselves that every day human-driven cars crash and kill people, probably more frequently too. So FSD is probably a safer bet, and it's probably getting safer by the day, or at least, based on what I understand. And I'm not an expert on this. So, okay. So we've gone from 104 roughly to 200-ish. How do we close the gap, Simon, for the remaining $445?
The really interesting piece, the one that's the most valuable of all, is what Tesla is calling a robo-taxi network.
Mm-hmm.
Think of it as Uber without a human driver. And in fact, the car doesn't even have a steering wheel. It's just, it will pick you up wherever you need to be, and it'll give you a ride there, just like Uber's doing today. You pay through the app. It's going to be a lower price, probably about $1 per mile to start, mm-hmm. which is incredibly affordable. You don't even have to buy a car anymore. You just have Tesla's app.
Yeah.
Go wherever you want to. You pay $1 a mile. Tesla takes 20% take rate from that.
These are Tesla-owned cars, or these are just, Joe Blow rinse out his Tesla when he's not using it?
So that's exactly the right question to ask. Tesla is not going to create the fleet themselves. They're going to sell you, James Early, a Model 2, or
mm-hmm.
kind of a lot of the same components that would go into a Model 2 in terms of the battery size, the chassis, the drivetrain, things like that. But then, James, this is your moneymaker now, right? You buy it for $25,000 up front, and then you send it out, to pick up people, and it's kind of, putting money into your bank account every day. And
it reminds me years ago, Simon, of this SETI, S-E-T-I, the search for extraterrestrial intelligence. Like, you could set your computer, like, processing, some kind of like space satellite, inputs to see if there are aliens out there. And it was just like a nonprofit thing. But this is the for-profit thing, because nobody drives their car 24/7, but maybe some drunk guy needs to get home from the bar, and hopefully he's not going to vomit in my Tesla. But, I can make $30, but it wouldn't be a ton of money. Obviously, $1 a mile, and I'm guessing Tesla has some take of that, and I've got some take of that, and some of the part of my take I've got to put towards maintenance or whatever else, right? But my car is literally sitting idle otherwise, so maybe what do I care, right?
Yeah, and there will be fleets too, right? Hertz is going to be all over this. Avis will be all over this. They're going to buy Teslas, but the point is that Tesla's going to still sell the robo-taxi car up front to someone else. They're going to take care of the maintenance. They're going to be doing the charging. They're going to deal it with if somebody throws up in the back of your car when you pick them up 3 a.m. All that is off of Tesla's hands. They'll sell you the insurance too, mm-hmm. to cover everything. But it's ultimately you think about it, James. If you buy this car for $25,000 and it's out there driving 50,000 miles a year for you, making money, if that's $1 a mile, 50,000 miles, Tesla's keeping 20% of that. That's $40,000 for you in your pocket. You got a little bit of maintenance you got to do. You got to charge it and things like that. But realistically, you could probably pay that off in terms of return on your investment in a year, maybe a year and a half tops. I mean, this is something that a lot of people would be interested in.
Oh yeah, I mean, it's almost like everybody's their own Hertz now. I can envision people like on Turo, which is kind of like an Airbnb for cars, which I've used sometimes, because for the same price as like a Camry, I can get a Jaguar or whatever. It's the same thing for people buy multiple cars, rent them out, just like people have multiple Airbnbs sometimes. People could have multiple Teslas and rent them out. And it seems like it could really change society in a way too. I mean, maybe I'm getting too metaphysical here, but the younger generation does not have the same cachet as the older crowds. Like when I was a kid, people would have posters of a Ferrari Testarossa or a Lamborghini Countach on the wall, right? It was cool to have a car. There's always going to be that group, but it's maybe a smaller group as time goes on. And people see cars as more of a utilitarian thing, not necessarily with the same pride of ownership. And that might just shift to, a small number of high-end cars, whereas kind of mass market cars society will change from this, I guess, in other ways too, if it actually comes to bear.
Yeah. And Elon knows that. I mean, like he thinks of these less as upfront, one-time revenue generators and kind of ongoing, fixing this system, which he's trying to get the entire world off of fossil fuels, right? If you look at Elon's kind of master plan of what he wants to do, he wants to have 100 million Teslas that are all buzzing around out there picking people up. And then on top of that, he's selling the full self-driving software to anybody who owns it. He's selling the car up front. He's collecting, a cut from the take rate, the insurance, you kind of have a maintenance and service package that's included in there, stuff like that. I mean, there's a lot of ways that Tesla wins by standardizing and centralizing a lot of stuff that's kind of a headache for a lot of us in terms of car ownership.
Yeah. I remember from when I was a kid, I watched a show, this Lifestyles of the Rich and Famous, and they had this guy, John Paul Jones DeJoria, the guy who was homeless, living in his car, and then he founded Paul Mitchell shampoos in Hawaii with this awapui lotion, and he became a billionaire. And he said, successful people do all those things that unsuccessful people don't want to do. And I think there's a lot of truth to that. Thinking through the framework, that's hard, that's ambiguous. Culling specificity out of ambiguity is a hard thing to do. And Elon is very good at that. Let me ask you one logistical question, Simon, then back to the model. Logistically, I've heard, because I know you were formerly an alternative energy analyst, that you might need something like 90,000 or 60,000 miles on your Tesla before you're even at parity in terms of a goodness to the earth concept, because even though you're not burning those fossil fuels, you're using electricity, and it totally depends on where you live, how clean that electricity is, right? If you're using nuclear power, great, or solar power, great. If it's West Virginia coal, maybe not as great. And then you're using a collection of rare earths, which are not always mined in the most eco-friendly way. Do you buy that number, something like that?
Yes, it's a very good point, and thank you for the mention. I did before I became a stock investor. Was working on demonstration projects for renewable energy for actually a large oil company. We were trying to figure a lot of these things out, and it kind of always came back to solar, James. We tried to figure everything out, tried to do interesting things like geothermal and tidal and all these kind of sexy renewable energies. But wind turbines can only get so big. There's only certain pockets of the world you can even have geothermal and things like this. But solar PV specifically was always going to be the most economical renewable energy out there in terms of a levelized cost of energy. And Tesla knows that. Elon knows it too. That's kind of why he acquired his cousin's company, SolarCity. And his goal is to kind of complementary to what he's trying to do with the auto business, trying to get the energy business to fit that too. So we're not burning a whole lot of coal just to fill up, or not fill up, to refill the battery charge of these vehicles. I think that's part of his big plan. That's why he's trying to scale up everything that he's got with SolarCity side of the business.
Yeah, and I think the question, kind of piggyback off what you said, the question to ask is not what's the break even now. I mean, that's something, but what's the break even in the future, especially if more and more people contribute to Tesla now. Like, it's advancing technology. Hopefully it's going to get cleaner over time as well. So it's kind of a play in the future. Back to your model though, what is your discount rate? I know the market writ large has gone up, 9 or 10% over the years, in most years. So for maybe a blue chip, middle of the road stock, somebody might use a 9 or 10% equity discount rate. What kind of discount rate to use for Tesla?
Right around 10%, James, is where I'm at for this one, because Tesla, at least by the last check that I had, was the 11th largest company in the market. So it's right up there in S&P 500 kind of territory. Mm-hmm. We know the long-term returns of the S&P are right around 10.5% per year.
Yep.
It's been a little bit higher here recently. Tesla's getting a little bit better than average return on its cash. It's actually got like $30 billion of cash in the bank right now, which you're getting a nice little 5% rate on.
Yeah.
Overall, I think it was around just under 10%. I think 9.78% discount rate.
Got it. Okay. And I'm guessing, I don't know that much about Tesla. I don't own the stock. It does not have much debt, or does it?
No. In fact, Tesla is almost entirely equity funded. A little bit of long-term debt that does carry on the balance sheet, mostly equity though.
And that debt is probably a very low rate. They probably financed it a couple of years ago before rates went up, like many of the smart companies did, and now they're sitting pretty, just like a lot of us. We got these home loans at 2.5%, 3%, whatever, and nobody wants to sell because of that. No stock is without risk. In this case, no investment thesis is without risk. Forecasting something could go up to $645 per share. Obviously, there are plenty of risks that could happen. It would seem like the FSD part is a little bit more. I mean, the regular car part is the safest. The increased FSD adoption is the second safest. And this really big picture story of changing the world as far as renting out your car, dollar per mile, that's the thing that's most at risk. Like, do you put a probability on how do you account for that risk, basically?
Excellent question. And so disclaimer, Tesla is not a biotech company, but let's at least use the same kind of framework of how we might value this, right? If you think about binary events, right? Mm-hmm. A lot of drug developers, when we're valuing those, we say, okay, if it gets this drug approved, it's worth $1,000 a share. If it does not get this drug approved, it's worth $0 a share and the company falls apart. Companies selling today for $100, probably at about a 10% chance of the drug getting approved, right? It's in terms of what kind of risk do you want to take? The expected value, if it proves, if it works, it's worth $1,000. If it doesn't work, it's worth $0. What would you pay in terms of share price today? If it's worth 10% or $100 is worth 10% chance of success. Let's use that same idea of a framework for Tesla, where if it does succeed in the AI ventures that we've spelled out here, full self-driving and the robotaxi network, let's just say if Tesla dominates and does very, very well with that, $645 a share. And if it's just a car company, which has already shown that it's done very well with, $104 a share, right? So you got a delta there of, let's call it $540, right? Between $100 and $640. Tesla at about $180 seems to be the market saying it is assuming about a 15% chance of success of getting all the way to that $645 per share. So if you follow what I'm saying here, what I mean is that $180 could be really expensive if Tesla's just a car company today, but it could also be really cheap if it continues to do really, really well with the autonomous driving, and it's actually worth $645. There's a bunch of points in between there, James. Maybe it succeeds a little bit, maybe, some things work and some other things don't. But in terms of kind of how we think about Tesla and investing in Tesla today, as somebody who's going out and buying the shares, you have to have some faith in Elon succeeding in the AI setup to justify the valuation. But there's also still plenty of upside if he does succeed.
So it's kind of a repeat or a version 2 of Tesla's beginning, right? I mean, it's a company with a big plan, with a big, bold founder who tends to succeed, not always, but has tended to succeed. So in a way, it's sort of a bet, like, is what Elon has planned going to actually come to fruition? Is it really going to happen, basically? So obviously, it's nobody can know that, like, for sure, right? And investing is about ambiguity, and the more ambiguity you can tolerate, the more money you can make or lose. I mean, there's no free lunch in investing, but basically it would come down to somebody's watching this saying, hey, is this right for me? You would not counsel anyone, I'm sure, to put a huge part of their net worth in Tesla stock, because there is a fair chance of this not happening. You're not pounding the table saying this is happening for sure. It definitely could happen. And it sounds like you're saying the market's 13 or 14% chance, whatever it was, of this happening might be a little bit low of an estimate in your mind. You think that there's probably a higher probability of that happening than the market predicts. Is that accurate?
Yes. And just maybe to kind of wrap this all together in terms of a risk versus reward of why even do this in the first place, right? If it could be anywhere between $100 and $640, my goodness, that's a huge range of outcomes. Why even attempt to do something like this? With all due respect to some companies in the market, they're fairly easy for people to do models on. Mm-hmm. And we're modeling Chipotle, we're modeling Starbucks, we're modeling Target. We can probably, James, between you and I and a sharp pencil, figure out how much sales, how much cash flow those companies are going to get for the next 5, 10, 15 years. And analysts do. If you kind of look at the consensus estimates for companies like those, they never really knock it out of the park, right? They're always within kind of 5% of consensus estimates, which is what Wall Street analysts expect this company is going to do in any given quarter. Where things really get interesting is a company like Tesla, which does not grow linearly like this, but it grows at a much, much steeper inflection point. When the Model 3 catches on, everybody wants to buy a Model 3. When the Cybertruck catches on, it's still slow today, but we're going to see a point of inflection for that. Same thing with the Model 2, the same thing with the autonomous driving. And you have to be a little bit comfortable being a little riskier as an investor to take those kinds of risks, assuming that it's going to pull it off. And again, if you're kind of playing by a lot of the rules that a lot of the institutions maybe are, maybe if you're managing somebody's family fund or a retirement account, stuff like that, you don't want to stick your neck out there and have to get a phone call saying, how did you lose my money? Well, you say, oh, it didn't work out what I was expecting to work out. But as an individual investor and, one that embraces discounted cash flows, and we were talking about the process earlier on this show, I think it's very valuable to say, okay, this is the most likely outcome, even if it's not following a linear progression, but still knowing everything we know about Tesla, ramping up gigafactories, the size of the prize for AI. This is how you come up with price targets that might sound ridiculous. $645 is a lot of way to go versus $180 to share today. But again, you have to be uncomfortable with those uncertainties. There's a lot more risk in a company like Tesla than there is in a company like Target or Chipotle.
Fair point. Cybertruck, ugly or cool?
Both, maybe.
Fair. Yeah. I kind of have the same opinion. Let me ask you this, Simon. So it seems like one of the issues or challenges with Tesla, with EVs, with really a lot of the green industry build out is, hey, this is great and the world wants to adopt it, but guess what? There's not enough copper. There aren't enough rare earths without sending prices through the roof if we actually fulfilled all that demand. You've laid out a case that is heavily dependent on this sort of rental aspect that would seem to not hinge on everybody buying a bazillion Teslas. In fact, if I'm renting one, I don't need to buy one. How much of that sort of capacity constraint risk or do you think we have in this situation?
I mean, China is a question mark, right? And there's a lot of challenges with even sourcing a lot of these materials, right? You
Yep.
just saw that there's now fresh tariffs on a lot of Chinese materials. Lithium is not one of those, interestingly, but there are rare earth metals that are included in there. Not to mention the political subsidies. $7,500 here in the U.S. If you buy an electric vehicle, you get credit, you get a tax credit for that. But UK has pulled their subsidy. Germany has pulled their subsidy. A lot of these developed markets are saying, hey, we want to encourage the transition away from fossil fuels and towards electric vehicles, but we also don't want this to be a huge crutch that we're always just kind of paying. Is at the point that this gets price competitive with other internal combustion engines. Let the market do its thing, free of government intervention. And those are big questions, right? For globally where it stands. I think that Elon is building gigafactories and securing supply, knowing that he's going to have to produce these. But the Model 2 is going to be coming out of Austin, James, in my opinion, rather than Shanghai, because of political risks, geopolitical risks that are involved with this. It's going to be a lot more expensive, in terms of what the investment's going to have to be for gigafactory in Texas than it would be in Shanghai. But you kind of have to accept that because you need the security of supply for the American.
Yeah, if you place an order, you'll actually get your Model 2 if it's coming from us.
You should have crossed the ocean either, right?
Yeah, definitely. So I'm just looking here, Simon, at your write-up. You cover all kinds of things that, it's probably hard to get into in a video, and maybe we can show a few screenshots to those watching. You cover the gross margins, the different assumptions for the cars, the R&D, sales and marketing expenses, things like that. Tesla's cash, the interest expense, which again is not too high, various stock-based compensation. Even I know for tech companies that can be pretty big. Tesla, 41 billion in net income, 50 billion in 2040. I'm looking at here, so that's so obviously some very nice growth. I'd love to have just a fraction of that net income myself. In other words, you got the full kitchen sink in here. Again, we'll show some screenshots, and if somebody says, "Hey, I'd like," oh, here we go. Yeah, I was looking at my own screen. I see it on here. So if someone says, "Hey, I want more of this, I want to look at the full model and have a chance to play with it," can they get this for free on your website? Do they have to subscribe to your service?
You do not need to subscribe to 7 Investing to get access to it. I posted everything for free on 7investing.com, James, including the final price targets and how I came up with them. But the interesting thing, the hook for me is that things do change over time, right? Tesla's going to continue to innovate, and every quarter we're going to get a little bit closer to the truth of what things are going to look like by the year 2030. And so everything's free right now up on the site, but I'm also going to change it every quarter as I get more fresh information. And one of the things I really like to do, this is kind of what got me into 7 Investing in the first place, was to have that interactive conversation with individual investors of say, hey, why are you assuming this? Why are you using this as the input? Why is this your discount rate? A lot of the same stuff you and I chatted about here today, James. We have a 7 Investing community forum to kind of share a lot of those inputs and assumptions. So at the end of the day, investing is personal. I'm not saying buy or don't buy Tesla stock, but here's kind of a good framework to put a number on the stock price, at least so you can kind of know what you're getting into if you do buy shares today.
I think it's a great way to put it. As humans, we are afraid of ambiguity and we are drawn to certainty. And I think that's true in finance, and it's also true in medicine. Those are two areas that both affect our lives very much, but which have a lot of ambiguity. And we're kind of drawn to authority figures or to rules or to valuation estimates for a reason, because it's like a balm, a salve. It eases that pain of ambiguity, but sometimes we're drawn a little bit too much. So I think you phrased it well, and you're being intellectually honest by putting this model out there and saying, look, if these contingencies fall into place, this is what it could be worth. These may not fall into place, or some of them may not. We don't know. It's not a black box. It's not just Simon Erickson saying, hey, this is $645 per share. This is, you're basically opening up your kimono for people to see, and they can decide how realistic or not, or where their beliefs fall in relation to the model. And I think that's a nice way to do it. So thank you for doing that.
Absolutely, James.
Awesome. So if you are interested, obviously you can check out Simon's website. I'll put a link in the show notes. We'll put a blurb on the screen as well. And he's kind enough to share some of those screenshots earlier. Simon, always informative, especially now with a very hot stock, and your post, your model is getting some deserved publicity. I think we need more of this in the investing world and the dialogue out there. So thanks for starting this, and thanks for your time here today. And thanks, as always, to you guys for watching us at home.